why not put your money to work?
Well, ladies and gentlemen, thanks so much for tuning into the Crypto Tape. I'm your host, Frank Chaparro, and I'm pleased to have joining us on the other side of the mic, Tom Lee of Fundstrat. Thanks so much for taking the time. Good to see you.
Great to see you, Frank.
You look in good spirits. So I feel like your travel is extremely hectic these days, being sort of the font of wisdom of the DAT and Ethereum world. Is that the case?
Yeah, it's been busy. A lot of meetings, a lot of Zooms, a lot of conferences, and a lot of folks want to sit down and chat.
Do you feel the fear that seems to be undergirding the market right now?
Yeah, 100%. As you know, no matter how long somebody has been in markets, and that's whether in crypto or in equities, price still determines emotion. So when prices are declining, nobody's feeling very confident. So there's a lot of anxiety, a lot of anger and emotions and second guessing. And I think too many people make, I think, what I'd call reflexive decisions so they're using sort of primal thinking instead of strategic thinking, but that always happens during declines.
Why do you think that when I look at, obviously, crypto Twitter or just get a sense of the market, maybe at some conferences or in my day-to-day, the sentiment, the fear feels almost worse than it did in the wake of FTX, which was this almost cataclysmic credit crisis that unraveled. And today, when we think about what some of the catalysts are behind this sell-off, they seem so much less dire for the industry. I mean, because of all of the tailwinds that exist for crypto, whether it's stablecoins or RWAs, but this drawdown almost feels just as painful from a sentiment perspective.
Yeah, it does. I think that the reason it's felt so bad for folks is, number one, I think there's three things, many more than three. But number one, I think in the back of people's minds, they've been thinking there's a 4-year cycle. And so, as you know, when everyone carries a hammer, then all they see is nails. So in their minds, everything that's happening is confirming that we're in a 4-year cycle. And I've had a lot of people show me that chart, the 391 days, right? 1,064 days of gains and then 364 days of declines. And that's number one. So it's the pattern recognition in people's minds. I think the second is, as much as people have been excited about AI and quantum, I think quantum is kind of viewed as quantum progress is seen as a threat to crypto. Or crypto hasn't figured out whether it's good or bad for crypto. Because as you know, there's a lot of people talking about the encryption risk for Bitcoin and other cryptos because of quantum. And the third reason I think it's felt worse, Frank, is maybe the price hasn't really reflected the mass liquidations that have taken place. You know, I think is maybe the reality, is that Bitcoin and Ethereum have held up really well, but I think there's many stories of people's accounts being wiped out. So I think that that's not reflected in the price.
And that's the other issue at hand, right? I think for the first time in crypto's history, you have driving price activity, a confluence of factors that didn't exist or that wasn't the case when it was more of an isolated asset class. So people are sort of approaching the market maybe with the same tools in their toolbox that they did in 2018, 2021, when in today's environment, it's impacted by a myriad of factors that impact all markets. It actually, this conversation is reminding me of a tweet from Jonah, who does the 1000X podcast, former Cumberland, who was responding to somebody who was, crying in the casino about how if Trump wasn't president, maybe we'd have 100K, 120K Bitcoin. And his response was, if this was the case, and if we had this sort of backdrop with a different administration, a more draconian administration approaching crypto, we'd be at 50K Bitcoin potentially. And that's just to say that there's a number of things that are going to impact the price of an asset, including macro, including internal crypto factors. But I guess the question is, what do you think is the most important, right? Why is the market so under pressure? Is it those market structure issues that you're sort of alluding to?
Yeah. I mean, as you know, I have a long history in macro and looking at markets. And if we look at risk assets in general, I think people become overly tied to a narrative and simplicity, thinking that explains markets. Like, for instance, I think too many people that do equities think, hey, a company has great earnings, the stock should go up. Or they'll be like, inflation's high, so stocks should go down. Or, the ISM's below 50, so we should be in a bear market. But as many people who try to understand macro know that those things rarely explain what stocks do. And so you're right. So as crypto starts to have more macro and institutional investors and then be tied to money flows, the price of crypto won't always make sense, but if someone, if I was just to make some casual observations, since late October, a lot of the things that have corrected in risk markets have been the things that did really well this year. So like the AI stocks have sold off, the nuclear names have sold off, the quantum names. So these are, they've been very popular with hedge funds and retail investors. And they've had what you'd say is their price has outperformed the expectations around earnings growth. So basically the risk premium has fallen or their multiples have gone up. So that's what's derated. And if someone asks me why things have derated, I think it actually is just possibly a couple of things. One is the Fed isn't really dovish. I mean, the Fed, people haven't decided, and the Fed still hasn't decided if we're in a disinflation cycle.
Yeah.
And if we are, they should be cutting. But as you know, every Fed meeting is a coin toss. I mean, look at in the last week, the odds of a December cut had dropped. They went from 70%, dropped to 30, and are back to 67. I mean, that's for Fed cutting in December and this close to December. Mm-hmm. The fact that probabilities have moved that much show you that there is so much uncertainty around monetary policy. And as you just kind of described, the current White House and the president is very divisive because there are those who didn't vote for him. And for whatever reason, this White House has really become a lightning rod for divisive and dissent. I mean, there was even last week some military members suggesting they should disobey orders from their commanders. I mean, that's very politically divided. And the third is there probably was leverage being built up in the system. I mean, in equities and in crypto. And so we're just seeing a leverage reset. I don't know if that really helps, but I mean, I'd say that those are contributing to why crypto probably isn't performing as well as we think, because you're exactly right. There's so much building being done. And actually we know that there is so much being built by Wall Street wanting to actually embrace and build on the blockchain. So, does that mean crypto is broken, or are we in a period of time where the fundamentals are doing better than the equities? I mean, I think that's where we are right now.
It's interesting. I mean, you're 100%. In the paper today, right? We saw right here, Boston Fed Susan Collins says she sees no strong need for another interest rate cut next month, underscoring the challenge that Powell faces. And it just doesn't seem like they think that inflation is under control to get to a place where we can aggressively cut rates. And that's scaring the market. But I do wonder, crypto seems like it's in a unique position where, let's say the Fed did say that they were going to cut 50 basis points in December, made that announcement. I feel like crypto would react less positively to the news than equities. And whenever there's bad news, especially over the weekend, it seems like crypto will draw down in anticipation of the news or in anticipation of how the markets will react on Monday. And then when the markets react negatively on Monday, crypto draws down even further. And it's kind of like almost stuck. I mean, it's stuck in the doldrums, but it's stuck in this position where good news is meh and bad news is really bad. And that's something that I'm trying to kind of unpack.
I mean, I'm not entirely surprised, Frank, because number one, the Fed is the most important entity in the world. I mean, as you know, they say bull markets don't die of old age; they get ended by the Fed, right? So maybe the Fed pretty much drives what happens to risk assets and then ultimately to the business cycle. And this current Fed is not operating with the clarity that most investors want. And part of it has to do with there's, of course, been a very visible dispute between the White House and monetary policy, and even questions of Fed independence. And as a consequence, Powell, I think, has done a really good job of navigating this. But keep in mind, he is the Fed chair, but then he has to corral all the other voting members, of the committee, the FOMC, and each of these voting members represents thousands of people that work for them. So the Fed is 30,000. I think maybe 20 or 30,000 total employees. And as you know, they're concerned about their existential independence. So I think every voting member feels that pressure from everybody that works for them that if they cut rates, they're just bowing to the White House. And whether or not they claim to be independent, they can't escape that pressure. And I think that comes through in every comment. Like what you just cited, someone from Boston, the Boston Fed, saying they don't see the need for a cut. Objectively, that's dead wrong, because the bond market, the Fed funds implied futures, or even 1 year forward inflation say there isn't really an inflation problem, which means if inflation is falling and Fed funds stay here, real interest rates are getting tighter. So the Fed is unwittingly causing monetary policy to tighten, because as interest rate expectations fall, and the UMich survey showed a drop on Friday, they're actually unleashing more tightening into the economy. So I think it is a real problem. But of course, the Fed can course correct really quickly. But over the weekend, people read the paper, like you said, and price makes people drive sentiment. So not only do people panic over the weekend, but as you know, outside the US, everyone looks at this and if they're getting concerned about monetary policy and they own a lot of crypto, they're just going to sell their crypto.
So what do you think? Obviously, rewind the clock 2-3 months ago, I feel like the inflows from ETFs, from DATs, drove the crypto market in addition to macro. To what extent does the sort of unraveling of DATs, so to speak, How much is that playing a part in this story?
Yeah, DATs have been part of the 2025 narrative. And I think that there has been, as the number of DATs have grown, and we've talked about this, not all DATs are created equal, because a proper DAT, a proper digital asset treasury, really needs to serve as a bridge, right? Because it's a bridge between the institutional or public equity world and the crypto world. And a DAT there shouldn't just represent passive exposure to crypto. It should really serve a function. And so MicroStrategy, as you know, is really the blue chip and the flagship and the first crypto treasury. But what they've done is they've accumulated a lot of Bitcoin, and then they've essentially turned it into a type of financial institution where they're productizing their Bitcoin holdings and offering yield products, and in a way that takes advantage of the characteristics of Bitcoin, which is the volatility of Bitcoin, and it's also stable store of value, right? I mean, basically Bitcoin over the long run is going to go up in value. So they have an asset that they know is appreciating. And then, as you know, a lot of other crypto treasuries followed suit, a lot of Bitcoin treasuries, but many of them didn't raise capital in a way that created accretion for their shareholders, or they had expense structures that were expensive and less attractive than an ETF, or they didn't really have a clearly defined function. So I think that this is the shakeout that happens, but that's kind of capitalism. I mean, since 1970, 44,000 stocks have gone public. Okay. Now, we know there aren't 44,000 companies in the stock market today. The reason being, and we've looked at this, 90% of stocks fall 90% once they go public. And of those, only half of them ever recover. So basically, most companies that ever go public are failed equities. That's the reality. That, like, when someone says like SPACs came and went and only 5% survived, that's pretty true of IPOs. That's pretty true of spinoffs. That's basically pretty much true of any business. We know that in, like, for instance, in restaurants, 95% of restaurants fail after 3 years. So does that mean every restaurant is a bad business? No, it just shows you the businesses that survive must be really good businesses. And so in my opinion, what's happening with DATs is going to prove that the ones that survive and prevail or raise capital or are big are probably far better businesses than people realize, because they survived capitalism. You can't, just think about the premise. Someone says, oh, I'm just going to create a crypto DAT and my stock's going to go to the moon. I mean, it's kind of absurd, right? Because an equity investor is not just buying a ticker. They have analysts. These guys talk to the companies. They talk to the chairman. They understand the strategy, and then they want to know if their stock price is aligned with the vision. So I wouldn't expect most DATs to survive.
I guess the time horizon's different than in US, well, in IPOs specifically, or in restaurants. I like that example. You don't see 90%, 95% of restaurants, for instance, fail within a 6-month period of time, or however long we'll see this shakeout last. But I get the sense that it'll be shorter, and that impact, I guess, hurts. Things like the DAT implosion that might be on the horizon. Following so shortly, the DAT Cambrian explosion might turn off new flows or people from the market.
Frank, that's a really good question. I think that there's still unwritten chapters to the DATs, right? Because there's all these DATs trading below NAV. And if they have a staking business, then in theory, they probably can survive, because if they've raised money and they have 3% yield, or if it's Solana, 7%, in theory, it's a viable entity as long as they didn't take on debt. They will still have this problem of their stock price being stuck in the mud. And there is several ways to solve that in the future. One is the company itself is now essentially a closed-end fund trading at a discount, right? So what can they do? One, they can actually become an investment company and turn into an ETF, and then they go back to par. They can begin to, if they're a staking entity, they could pay out their staking yield, and they'd be a yield-bearing instrument. They can sell their crypto holdings, and some have done that and distribute the cash. But they have to distribute the cash. If they're going to sell their crypto holdings and just send it cash, then they're just misallocating capital. I mean, there's a signal, I think, if something's trading at a big discount to NAV, because it shows you the market doesn't believe that management team can allocate capital. So then the last option, of course, is that they should be consolidated away. But that takes time, because as you said, it's only been a few months. Most people have unrealistic expectations. They always say the problem with M&A isn't the buyer's willingness, it's the seller's price. So, if someone's trading at 0.7 MNAV and they want to get NAV, that's a 50% premium to the buyer. The buyer, there's a pretty high bar for someone to be willing to pay NAV for something at 0.7 times NAV. So it's going to be, it's a process there. But should that really hurt crypto? I mean, at the end of the day, there is a lot of reflexivity in crypto, but the debts aren't really what's creating the building, and that's not really what's driving, for instance, what's happening on blockchains and stable coins and real world assets. That none of that really has to do with debts, unless the debt itself is funding specific projects. And on the Bitcoin debts, I think that they had a theory that everybody would own a little bit of Bitcoin on their balance sheet. And I don't think that's wrong. But I think the debts that were small and subscale, saying that because they own Bitcoin on the balance sheet, they should be more valuable than another company that owns Bitcoin on the balance sheet. That's probably where the market is just repricing everything. And they might even be pricing whatever that debt owns as an operating business as a liability. And that's why they're trading below NAV.
One other option they have, right, is the ability, thinking about new flows, for instance, potentially in-kind contributions could be another avenue for them to take to raise more capital for people that are maybe sitting on ETH, Bitcoin, or whatever have you. I wonder, what do you think, what does the M&A cycle of this look like? What should we expect?
Yeah, well, it's a good question. First of all, what a DAT has to be aware of situationally, and that the people running the DAT, they're actually a public company. And public companies need to attract institutional investors. They can't just rely on retail investors or memeing it. And as you know, a lot of DATs were full of memes and kind of like, trying to make noise. But that's not what will attract an institution to take a big stake in your company. In order to have equity investors back your business, you have to have clearly articulated strategy. You need to have liquidity, it's kind of chicken and egg. And you have to have credibility. But the equity investors are going to choose to support the scale DATs. And I think that they're actually, as you saw, even in this downturn, look at the 13F filings. There have been many buyers of debts in size because, and as you even said, like with in-kind contributions, so it's a 351. Let's say someone wants to put more Solana or Ethereum into a DApp. They're going to be much wiser to say, if I'm going to put my crypto into a DApp, I want to make sure that that holding is then gobbled up by an equity investor. Because if it's just throwing it into a discounted price thing, that's what they call throwing good money into bad, right? I would never say, let's buy the 10th best AI stock trading at a discount, and because it's cheaper, I'm going to throw more money into it. It's always better to invest in the strongest company in the strongest space. So I think that in next year, I don't think that a well-run DApp should trade at a discount to NAV. So I mean, there are probably some good ones out there that shouldn't be gut punched the way they are. But the equity investor doesn't buy the 10th best company. They tend to buy the strongest company in the strongest space. And that's what creates winners and losers. I mean, look at, the equity market, like treat DATs like country indices. People have been buying the US for a long time until the rest of the world got so cheap that they bought the rest of the world for 1 or 2 years. But, at the end of the day, you really are better off buying the strongest company.
So you mentioned throughout this interview the extent to which the fundamentals of the growth of the industry are not necessarily translating into price appreciation in the underlying assets. You've done a good job about telling this story on Ethereum, probably better than anyone in a long time. Mike Novogratz, I think, did a good job early on with the ETH, this sort of digital oil narrative. You brought this sort of ETH is the undergirding force of stablecoin, which obviously is the kind of pillar of the 2025 narrative. How do you sort of communicate, or how do you see the growth of stablecoin actually accruing value to these networks? That is to say, maybe some people might look at them as being separate things. You look at October as an example. RWA growth was up 8%, ETH, Bitcoin down maybe 15, 20%, whatever it was. Why should those things maybe be more correlated than they are?
Well, I think that there's a flaw that most people make when I see crypto projects and people talk about crypto tokenomics or crypto economies or whatever economic model, which is that they have static assumptions. They'll say, oh, look, Tom, there's all this stable coin growth and there's all these L2s, but they're not generating fees for the L1. So therefore the L1 doesn't accrue value. That is the same as someone saying in Facebook, okay, when Facebook launched mobile and they said, well, Facebook, you're not charging any money for people to actually do mobile. You're actually just, it was free on the desktop, it's free on the mobile. And maybe you can sell 10% more ads on mobile, so therefore it's not really beneficial to Facebook. Do you realize how wrong people were about that assumption, right? Because basically Facebook is a UGI company. So the more people that use it, the more valuable it became as a platform for advertising. And of course, the network effects kicked in. And then today, Facebook dominates all the advertising business, but that was not evident in 2007. L2s, it may make sense, especially on Ethereum, to let the L2s grow, create a huge ecosystem, and not charge direct proportionate gas fees. Because if this is where everything is going to be built, then the L2 is going to accrue significant value. I think I think it's really absurd when people say you could have 10 trillion of stable coins and it's not going to benefit ETH because look, they're not charging any fees for that. That's basically Facebook's strategy, right? In 2007, they want to become the standard. So they really want everything to scale, and then they can always modify this business model later to accrue value to the L1. I think it's a perfect example of how, and I've seen this, the people who are an expert in a prior regime always think that they're an expert of the future, okay? That's like when I did wireless in the early 90s, and everyone has this problem, so and including myself, but in the early 90s, when I did wireless, okay, wireless was 34 million cell phones. And these companies that were cellular had to buy spectrum, which was expensive, or acquire spectrum through mergers or other ways, like some got it through the Catholic Church. Then they had to build networks that cost $50 per person of infrastructure. Like, so to build the entire country, you had to have billions of dollars, okay? And then you had to charge money for the service. But then you had to get people to buy a handset, okay? So in the 90s, everybody I met that was a money manager and really established, the vast majority said the cellular industry is going to fail because the long distance industry is powerful. The local telephone companies are powerful. They're not going to let cellular succeed. In fact, they're going to keep making cellular an undercut pricing so that cellular becomes a free service. So number one, that's the incumbency. People saw that the long distance telecom companies had all the money, and these are 50-year-old people. They probably barely found utility in a cell phone anyways, but young people saw cell phones very differently. And not only that, as cell phones grew, it transformed communications and it became bigger than gaming, media, landline, cable combined, because there were so many not only network effects from owning a lot of users, but you created a whole vast array of new services, including mobile advertising. So if an Ethereum blockchain captures 70% of all RWA and someone says it's not going to benefit Ethereum, that is someone who actually is using the same logic to say new technologies and new applications don't benefit the new entrants. In fact, as you know, there's a lot of people in Bitcoin that don't think there's anything other than Bitcoin that exists. I mean, there's so much tribalism.
Yeah.
And when people say L2s don't benefit L1s, that's a tribal view. I'd say it's, I've had the same people that tell me in the macro world, S&P shouldn't go up. The AI stocks are expensive. Quantum makes no sense. I've heard every negative argument for the stock market for 30 years. And I think people get into the same trap. Just because they have expertise in one domain or even one regime doesn't mean that they're going to be the dominant mindset for the next regime. It's really an important thing. I think people really need to open their eyes. And in fact, even as people are putting and writing the obituaries for DATs, they're forgetting that a couple of these are really going to be transformational businesses. But the vast majority were just experiments.
Perfect. Well, we'll leave it there. Thank you so much, Tom Lee.